When was the last time you paused mid-scroll, checked your bank balance, and questioned your direction, not your spending or bills? Not how to make quick money or chase trends, but which quiet decision today could shape every future paycheck? Most people never ask that, and their money stays stuck in a loop, coming in, going out, leaving little behind. Real wealth is not built through dramatic moves. It's built through steady action, repeated long enough to create momentum. That momentum is called compounding. Why compounding feels invisible? Until it isn't. Compounding has a branding problem. People associate it with boring math, dusty textbooks, or something reserved for finance professionals and trust fund heirs. In reality, compounding is neither complicated nor exclusive. It's simply money earning money, and then those earnings earning money too. Think of it like rolling a small snowball down a hill. At first, it barely grows. You could be forgiven for thinking nothing is happening. But as it rolls, each layer collects more snow, and soon the snowball becomes heavy enough that gravity does the work for you. That's what compounding does to money. Slow at first, relentless over time. And here's the critical insight most people miss. The snowball doesn't need to be massive to start working. It just needs enough weight to stop melting and start accelerating. Why fast money often slows you down. Before we talk numbers, it's important to clear the fog around common alternatives. Rental properties can build wealth, but they also bring midnight phone calls, repairs, vacancies, and paperwork. Crypto can deliver spectacular gains, but it can also erase years of progress overnight. Side hustles can help, but many quietly turn into second jobs that consume evenings and weekends. Compounding works differently. Once set in motion, it keeps working while you sleep, relax, or focus on living your life. It doesn't demand constant decisions or emotional energy. It rewards patience, not cleverness. That's why the most sustainable wealth strategies tend to be the least exciting. Starting from the destination. Let's begin with a goal that feels tangible. For many people, $1 million represents security, freedom, and choice. Not luxury for its own sake, but optionality. The ability to say no. The ability to breathe. Now here's the question that matters more than the headline number. How much do you actually need at the start for compounding to carry you there? Assume a long-term average return of around 8% per year, roughly in line with historical stock market performance. If you give yourself 20 years, you'd need roughly $240,000 up front to reach $1 million. That number feels intimidating. But now stretch the timeline to 30 years. The required starting amount drops to about $100,000. Nothing else changed. Same return. Same destination. Just more time. That single shift cuts the entry point by more than half. Why time is the most powerful variable? Time is the quiet multiplier nobody talks about enough. Add 10 extra years, and suddenly the hill gets steeper, gravity gets stronger, and your snowball doesn't need to be as big to begin with. This is why people who start earlier often appear luckier later on. They aren't smarter. They simply gave compounding more room to breathe. Even modest differences in annual returns dramatically change the starting requirement. At lower growth rates, the entry point rises. At higher rates, it falls sharply. But here's the twist most financial influencers avoid saying out loud. Return rate matters less than consistency and restraint. You can't compound what you keep interrupting. The real enemy of compounding. The biggest threat to compounding isn't a market crash, it's behavior. Pulling money out too early, skipping contributions, panic selling after scary headlines, letting gains sit idle instead of reinvesting them. Every time you interfere, the snowball stops rolling. Sometimes it melts. That's why the rule that matters most is also the simplest. Once the compounding machine is running, don't touch the gears. This isn't about being passive or careless. It's about understanding that wealth grows best when it's allowed to be boring. Why $100,000 is the turning point. You might wonder why so many experienced investors talk about a six-figure milestone. It's not because $100,000 is magical. It's because it's loud enough to be motivating. At a conservative 6% return, $100,000 generates $6,000 in the first year. The next year, it earns more, because last year's gains are now working too. Over time, the annual growth starts to resemble a second income stream. By year 10, the yearly increase approaches 5 figures. By year 20, the growth alone can exceed what many households manage to save manually. That's the moment compounding stops feeling theoretical and starts feeling real. The silent power of reinvestment. One of the most expensive mistakes people make is pulling gains out of the system too early, or letting them sit in cash where inflation quietly erodes them. Reinvestment is not a clever trick. It's simply refusing to let your money sit idle. Every dollar earned is like a new worker joining your team. The more workers you deploy, the faster the project finishes. Over decades, this habit alone can double or even triple the final outcome without requiring additional effort. Automation makes this effortless. Once reinvestment is switched on, discipline becomes default. Can ordinary people actually reach this level? Yes, and usually faster than they expect once direction replaces guesswork. Wealth rarely arrives through dramatic leaps. It grows through steady movement over time. Modest monthly contributions may look insignificant in isolation, but when combined with years of consistency, they become powerful. This is how 6 figures shift from feeling impossible to feeling inevitable. Most people eventually discover an uncomfortable but freeing truth: income matters, but it is not the main constraint. Direction is. Money without a plan leaks away. Money with a clear destination begins to multiply. When every dollar knows where it is going and why, progress stops being emotional and starts becoming mechanical. You don't need to be a financial genius. Another persistent myth is that you need to pick winning stocks or outsmart the market. You don't. Broad, low-cost index funds have delivered long-term returns in the 6–10% range for decades. For most people, a simple automated investment strategy beats complex ones. Not because it's smarter, but because it's harder to sabotage emotionally. Checking balances too often can do more harm than good. Every dip feels personal. Every headline feels urgent. Distance protects discipline. Wealth assumes patience. Panic destroys it. The seed that becomes a tree. Compounding rarely feels impressive in its early stages. Imagine holding a seed in your hand. You plant it, water it, and wait. For weeks, nothing seems to happen. Then a thin green shoot appears, fragile, unimpressive, easy to dismiss. No one applauds that moment. But beneath the surface, roots are forming, strengthening, anchoring. Years later, that same shoot becomes a tree with deep roots, wide shade, and quiet resilience. Compounding works the same way. Early progress looks slow and almost disappointing. Later progress looks obvious and unstoppable. What changed was not effort, but time, the number that changes the game. After accounting for realistic returns, market ups and downs, and real human behavior, one number consistently stands out as a turning point: $100,000. Not because it guarantees wealth, but because it changes psychology. At this level, growth becomes visible. Gains begin to feel meaningful. Motivation reinforces discipline instead of competing with it. Momentum starts to feed itself. The account no longer feels like something you are pushing uphill. It feels like something pulling you forward. This is where compounding stops being an abstract idea and starts behaving like a system that works with you, not against you. How to reach it without a high salary. The path to this milestone is simpler than it sounds, though not always easy. Automation removes friction by moving money before spending decisions can interfere. Increasing income doesn't always mean changing careers. It often means extracting more value from skills you already have. Redirecting every raise, bonus, or side dollar toward investments accelerates progress dramatically. Cutting expenses is not about deprivation, but about removing costs that add little joy and replacing them with long-term leverage. When these actions are stacked quietly and consistently, progress stops depending on motivation and starts following a timeline. If this changed how you think about money, imagine what consistency can do for your future. Compounding doesn't reward hype or luck, it rewards patience and direction. Start small, stay disciplined, and let time do the heavy lifting. If you want to be smarter every day, like and subscribe.